exactly right. We've had this balance for the last year. On the one hand, weakening fundamentals, especially in Europe and in Asia. On the other hand, confidence that ample and predictable central bank liquidity can insulate markets from the effects of that, plus technicals that on the whole have been positive. And what you're seeing today is both sides of that equation going against investors. There is a further weakening of fundamentals. And remember, the escalation of trade wars, and you've heard me say this over and over again, we're going to have more escalation. That's what all the bottom-up tell you. The escalation of a trade war increases the probability of a currency war. So fundamentals worsen today. And on the other hand, Chairman Powell admitted what a lot of people already knew, but it's good to hear it from the Fed, that he can't counter this trade uncertainty. So the market looked at both sides of the equation turning against it and sold off in a very broad fashion.
Yeah. So, I mean, if you add it all up, Mohamed, it equals slower global growth, which we know has already been a problem, right? The trickier question is, what does it mean for U.S. growth?
Yeah, and the even trickier question is there is a difference between what it means for U.S. growth and what it means for U.S. markets. So it is a headwind for the U.S. I don't think it's a strong enough headwind to tip us into recession for the reasons that you've heard earlier, which is the non-tradable sector, the service sector is still quite large, and consumers and the labor markets are in a good place. So it slows us. That's no doubt about that, but it doesn't tip us into recession. But markets are much more exposed to what happens to the rest of the world. So you're going to get a decoupling of markets. And what we all have to think about is the feedback mechanism from markets to the economy, the self-fulfilling expectations. That is where the danger is for the economy.
At this point, are you particularly worried about that? Where are we? Off from the highs, 5.7% from all-time highs on the S&P.
Yeah, I mean, markets could go lower, undoubtedly. And I think that you have to think in terms of three strategies than simply buying the dip. One is look for areas of particular dislocation. And there's more of them, by the way, outside the U.S. than in the U.S. Secondly, look for where there is an interruption in the supply chain, in credit in particular, because that's happening. And then thirdly, look for names that haven't been the sweetheart of recent rallies, but have these characteristics of being protected because they serve mainly a domestic audience. That is the strategy. It's very selective. And then wait before you increase the general exposures to the market.
Mohamed, you say you are seeing examples of dislocation in the credit markets right now. Is that here? Is that globally? Where?
Yeah, I mean, look at Turkey. Banks have stopped lending. And if you're able to construct private credit with a lot of collateral, you're getting paid a ton of money for mostly hedged risks, especially if the assets are held abroad. You have the same dynamics in a number of other countries. You're going to see high-yield companies in the U.S. now finding access to markets harder. So you want to pick your spot, and you want to focus on the dislocations, which is different from the strategy that has worked so well for the last few years, which is buy every dip because we have so much confidence in ample and predictable liquidity with pressing volatility. I think that confidence is being eroded.